SoFi, a company with the potential to disrupt the entire banking industry, is no secret one of our personal faves here on the channel. For the sheer amount of growth, impeccable business model, and outstanding seasoned leadership executing the plan and leading the way. Grab your Rolex Submariner and tell your wife you won't be home for dinner, because we are going deep into SoFi's financials and spilling the beans on what it all means. On top of that, we will be going over the drastically misunderstood Q2 2021 $165.31 million net loss that has the entire SoFi community and Wall Street shook.
That's shocking.
Shout out to everyone who asked for it, because here it is. After all the hype coming from both short sellers and longs, is the company making profits, or are the figures going down for real? What's the point of increasing revenue so significantly if expenses are going to increase with it? Welcome to Wealth Gambit. On this channel, we cover the latest stock trends and research. If you like that type of content, be sure to like and subscribe for more weekly content. Also, please note that we are not financial advisors, so please do your own due diligence. Anyways, let's get right into it. Let's highlight the most controversial matter in its Q2 2021 report that created panic amongst most of SoFi's investors out there.
Great Scott.
SoFi reported second quarter 2021 earnings of negative 48 cents per share on 8/12/2021. How did SoFi end up with a negative earnings per share? Loss is something that we all cringe at when hearing, and understanding why such things happen is an important part of being an investor. SoFi reported a net income loss for Q2 of 2021. Let's dig deeper. Earnings per share is calculated by dividing net income by its average outstanding shares. And of course, when you divide a negative income to SoFi's outstanding shares, it'll give you a negative result. EPS indicates how much money a company makes for each share, and a negative earnings per share means your share isn't making any profit. During their first conference call as a public company, SoFi CFO Chris Lapointe explained this loss by saying that what's important to call out in the number are non-cash items related to stock-based compensation, as well as the fair market value changes to warrants attributable to their business combination with Social Capital. In addition to those non-cash items, there are one-time transaction expenses as well. Now let's cut that information into bite-sized pieces so it'll be easier to digest. Lapointe pointed out stock-based compensation. What is stock-based compensation? Stock-based compensation is often used by startup companies since they typically do not have the cash on hand to pay employees competitive rates. So instead of getting compensated in full with cash, executives and staff are getting paid through cash and stocks. In this way, the company's management and staff may share in the company's growth and profits. The other thing that Lapointe pointed out were the fair market value changes to the warrants and one-time transaction expenses attributable to their business combination with Social Capital. Going public isn't free. As per the SEC, a SPAC IPO is often structured to offer investors a unit of securities consisting of number 1, shares of common stock, number 2, warrants. A warrant is a contract that gives the holder the right to purchase from the company a certain number of additional shares of common stock in the future at a certain price, often at a premium to the current stock price at the time the warrant is issued. And typically, warrant exercise prices are set well above the stock market's price at the time of issue and are usually good for several years. To put it simply, SoFi granted warrants to Social Capital in relation to their business combination and had to recognize the fair market value of these warrants and put it out in their financial statements for transparency. SoFi's price to book ratio is moving between 1.8 to 2.5 depending on the price of the stock. Companies who have been consistently profitable have market values greater than their book values because investors have confidence in the company's abilities to generate revenue growth and earnings growth. SoFi's book value is around $4.5 billion and its market value is between $11 billion and $12 billion. Next up, let's take a look at liquidity. Basically, liquidity ratios such as current ratio, quick ratio, and cash ratio cover the ability to pay its current obligations/liabilities. When we say current, this means those that are due over the next 12 months. A liquidity ratio that is more than 1 usually attracts lenders, as this indicates that they can be paid in a timely manner. For example, as seen in the illustration above, SoFi's current ratio 5.718 means its current assets are more than 5x its current liabilities. Next up, we have SoFi's business segments: lending, financial services, and the technology platform. Let's talk about the most obvious thing here. Increasing by about 55%, the company reported a much higher revenue than last year, and the highest among every source of SoFi's revenue, the lending segment. This has brought in a lot more money this year, bringing in a net revenue of about $315 million. Though loan interest income has declined in the segment, increases in non-securitized personal loans and student loan interest income saved the day. As for lending interest income, let's start off with the decrease in revenue. There's a 4% decline in the loan interest income, which amount to about $7.3 million from January to June 2021, compared with with 2020. This is because of the forbearance period in relation to student loans, which has been extended until the end of January 2022. This loss was balanced by the company's increase in non-securitized personal loans and student loan interest income of about 32.8 million and 11 million. In terms of interest expenses related to securitizations and warehouses, there is a 36% decrease from January to June 30th, 2021, compared to last year's data. Moving forward, securitization interest income decreased by 5.3 million or 39% for the 6 months that ended June 30th, 2021, compared to 2020. This is because of the million-related decreases in average securitization investment balances period over period, and a decrease in securitization float interest income. You might be wondering, what do these securitizations mean? As we know it, SoFi has lending segments, and when members take out a loan, SoFi converts these loans into securities and sells it to the secondary markets. Investors who buy a portion of these securitized loans would effectively be the lenders of the capital. But why do they do that? SoFi can just put these on their balance sheet, but that would limit the company in the number of loans that they can do. Instead, these loans are being securitized. Let's take a look at SoFi's lending segment from January to June as of this year. There's a significant improvement with about 158% growth in this segment due to loan origination and sales income, servicing income, and its securitization compared to last year. Loan origination is when a buyer secures a mortgage loan from a lender, while servicing income can be earned from technical, consulting, or other professional services. The highest revenue stream also incurs the highest expenses among everything else. Driven by the loan origination and servicing costs, this segment had an increase of about 12% compared to last year. But good news, they have already decreased major line items for their expenses like occupancy, travel, and professional services, and unused warehouse line fees. Financial services income rose by 413%. Interest income was mainly due to a burst in the number of credit card loans. As for non-interest income, the growth was driven by the increase in brokerage-related services and affiliate referral fees, and especially with the increase in digital assets trading volume on their platform. Underwriting revenues and advisory service revenues are the ones which led the growth of this sector. Finally, we have financial services expenses. The segment of financial services incurred a 34% increase in their expense from January to June 2021 compared to last year. This happened due to massive allocation of their fund to direct advertising, member incentives, and other general expenses. We all know that SoFi acquired Galileo. This falls under their technology platform segment. We're going to cover the income and expense. We're sure you're familiar with the dip that's been happening since the Q2 loss announcement. One of the big things attributable to the Q2 loss was the deferred tax liabilities that were recognized in connection with their acquisition of Galileo. What exactly is a deferred tax liability? A deferred tax liability is a tax that is owed but is not due to be paid until a further date. In this instance, SoFi recognized its tax liabilities for the acquisition of Galileo even when it is due at a later date, which is a reportable segment in its financial statements based on accounting rules and principles. In their net revenue, can you believe that it has already grown 356% compared to last year's January to June figures? It's obvious that SoFi's member growth increased extremely from its day one up to now, and their newly acquired business segment, which has had a significant contribution to this growth, but the acquisition took out quite a huge amount from the company because of the deferred tax liability of Galileo. With a 935% increase in compensation and benefits, the company incurred the most outflow in compensation and benefits, occupancy and travel, as well as professional services. That's an 806% increase in directly attributable expenses, and it's really not a good sight, which obviously created some panic for investors. In the recently held Robo ranking, Robo advisory product line classified under SoFi Invest has clearly shown the opportunities that await SoFi. The company's assets under management, or the total market value of the investments that SoFi manages on behalf of their members, amounting to 426 million, has nearly 3x from the year prior. Even though SoFi seems like a quote-unquote tiny upstart in this category, the company was named the quote-unquote best overall robo-advisor by Backend Benchmarking, validating SoFi's strategy and performance. Let's now get into products and members. Let's have a short overview of SoFi's members, products, and services. In their second quarter reports, SoFi's members reached 113% growth compared to last year, an additional 1.4 million members totaling about 2.6 million members. As for SoFi's overall products, the year-over-year growth was 123%. The numbers can't deny that SoFi's financial segment is disruptive. It's just a matter of time before it reins in the financial market. With its financial services segment as the company's major player, it could finance its lending and technology business as it grows rapidly. We here at Wealth Gambit are bullish on the stock, and we believe in SoFi because we have studied its fundamentals and background and saw a very competitive company that is about to explode. Even the quote-unquote street projected that the company would grow at a CAGR, or compound annual growth rate, of about 38.9% over the next 5 years. It's very clear that they too are pretty optimistic about SoFi's future. Furthermore, SoFi's merger with social capital Helios Sophia valued the company at around $8.65 billion, which according to PitchBook was valued last May at $5.7 billion. And as of recording this, SoFi's market value is more than $11 billion, which tells us that it has almost doubled its value since it went public in June 1, 2021, and it has only been 3 months since then. While ratios and numbers give you a better look at a company's whole picture, it's just one of the many factors to consider when investing in a company. SoFi may have lost a bit off the top, but here at Wealth Gambit, we are pulling an Anthony Noto and not unloading any shares. Noto has recently actually added to his position, adding over 21,000 shares to his position, or in dollars over $300,000. Although we don't necessarily have $300,000, we will definitely be looking to add to our position. That about wraps it up for today's video, guys. If you found any value in this video whatsoever, please smash that like and subscribe button for more weekly content. What do you think of the fundamental analysis, and are you bullish or bearish on the stock? Let us know in the comment section down below. Best comment gets shouted out in next week's vid. Until next time, peace.